The purpose of this video is to discuss inventory errors and explain how we can uh, see the effects of those errors on the financial statements. Okay, this is one type of error. Obviously, there's many types of errors that can occur, and I think this is worthwhile discussing because I see students struggle with this many times. So before I illustrate how the error affects our financial statements, I want to first discuss the difference between a periodic and a perpetual inventory system. And I know most of you have already heard about the difference, but I'm going to refresh your memory because this is important to understand as well in analyzing these errors. Okay. Now, don't mix this video up with the video I have on error analysis in general. So in that video, other accounting thoughts, error analysis, there I illustrate a potential framework or a way in which you can approach any type of error on the financial statements and understand how it affects the components of the financial statements. But I'm also doing this video here because I have found that students need just more information on specifically the type of error related to inventory. Okay, so the first thing is this. You learned this way back. If anything, this is probably one of the first things you learn about inventory. When you do the periodic inventory system, anytime you make purchases, anytime the business makes purchases, you're going to debit the temporary account called purchases, and then you're going to credit accounts payable. Now, this purchases account is an asset account, but it is temporary because at the end of the period, we close it out once we know how much inventory is left. Recall, this is a periodic inventory system, so you're not keeping track of your actual inventory until the end of that period, whatever that periodic period is, okay? That could be a week, a month, at the extreme, let's say a year, or whatever the case may be. But once you determine that you're going to do count at the end of the inventory, account of ending inventory at the end of the period, then that's when eventually this purchase accounts, notice right here how it's credited, gets taken out. So quickly, let's illustrate this formula first, and then we'll do the debit to credit again. This is your general formula for any type of inventory. You have a beginning inventory that just exists there, and we're going to call that X. And to that, you add any purchases you've made during the period, which is this debit to purchases here, and let's call that Y. So then the summation of X and Y gives you goods available for sale. These are the goods that you can either sell or not sell, right? If you sell them, it's cost of goods sold. If you do not sell them, it's ending inventory. So we do this subtraction of ending inventory at the end of the period to get cost of goods sold. But how do you get this ending inventory? The only way to do it in a periodic inventory system is for you to actually count the inventory. So let's say you go and physically count at the end of the period what you have left. And we're going to say that what's left is Z amount. Okay, we do that count. So if I go in there and I count, I subtract Z, then I get my cost of goods sold, which goes on the financial statements, right? On the income statement. The ending inventory count, the amount here, goes on the balance sheet as an asset, and that'll be it. So how do I account for this? Well, now that I know that ending inventory is Z, this becomes the ending inventory at the end of this period, but next period it'll become the beginning inventory, okay? I also know cost of goods sold A, so I'm going to debit A for cost of goods sold, and I'm going to remove whatever amount was in there for beginning inventory. I'm going to actually credit inventory. Even though I'm debiting inventory here for Z, I'm also going to credit it for X because this amount X is old. This is just what was there at the beginning of the period. So we're just going to take it out. And we take out purchases. And this journal entry here is the way that you update ending inventory to the correct amount. And at the same time, recognize cost of goods sold. Okay, so that's a refresher on the periodic inventory system. Now, on the perpetual inventory system, the idea is that you're not waiting until the end of the period to account for sales in cost of goods sold. You're doing that as you go. So same thing with inventory purchases. When companies buy stuff, it's debit inventory now, because now we're going directly into the inventory account. By the way, let me write inventory here, because I want things to be comparable. I don't want you to get confused here. So this is inventory, and now I'm telling you, when we do the perpetual inventory system, we go directly to the inventory account. We don't use that intermediate purchase account. So this would not exist. Purchases would not exist under the perpetual inventory system. So we debit inventory, credit AP. Every time we make a sale, okay, we recognized immediately the revenue. So I'm here calling it Y plus P. Imagine P is some form of profit, okay, some markup. So if we buy the item for Y, hopefully we sell it for more than Y, right? So this will be Y plus a profit, and then here's your revenue. This is accounts receivable. And then immediately, since this is a perpetual inventory system, immediately we take out that inventory from the books. So if you notice, you credit Y, and then you go into cost of goods sold. So with the perpetual inventory system, you technically will never have to do this, right? Is the idea. You don't need to do an inventory count like you do with periodic in order to update the inventory account. You don't need that, because you're constantly updating the inventory account with every sale or purchase you make. Now, that's kind of true. But the reality is that whether you're using a periodic or a perpetual inventory system, no matter which one you're using, at some point in time, you do have to get a physical count of the inventory. Okay, so for the periodic, when do you do that? At the end of each period, right? For the perpetual, it depends on company policy, but once in a while, you want to go and check how much inventory you have. So when you do that, you're going to do an ending inventory count at the end of a period. And just for sake of conversation, let's say it's the same period, right? Let's say this is 1 month. At the end of 1 month, we want to also count and see if whatever's on the general ledger on the accounting system is the same as the inventory count. So I count the inventory just the same way as I did under the periodic system, and then I compare that to what's on the general ledger, the accounting system. And often we find that the ending inventory per our physical count is less than what's on the books, right? Sometimes there's damage, there could be theft, things for which we have not accounted for as a credit to inventory. And when that's the case, we got to go in there and say, well, you know what? Whatever that amount is, let's call it B, we got to remove that from the books. Okay, we got to remove that from inventory, because our general ledger, okay, that would be this account, our general ledger is overstated. Since it's overstated, we need to just expense that to cost of goods sold for B amount. And then the opposite could be true, but it's, usually this is what's going on, right? That inventory shortages are found whenever we do a count. You could have a situation where maybe you didn't record some purchases or something, and now you're finding that out, right? But in any case, if you find that your ending inventory count is greater than what's on the books, then you just have to increase inventory. And I'm putting cost of goods sold here, but it could be different things. If it's a purchase we haven't accounted for, then it would be accounts payable, right? So the credit here is not as important as the fact that if you need to increase inventory, you debit inventory. If you need to decrease inventory, most likely that's loss, so that is an expense. Okay, so quickly, why am I telling you this? Because if I make an error along the way here on the inventory count, then that error flows to this calculation right here, meaning that if this, for some reason, I overcount, then this cost of goods sold is going to be understated. If this is over, this is under, right? Same thing here. If you're in the perpetual inventory system and I make an error and I overcount my ending inventory, same errors here, okay, then I will, if I overcount, then I'm going to go in there and I'm going to do this. I'm going to debit inventory, even though I should not have, because I'm saying, hey, there's more inventory than I thought. And I'm going to credit cost of goods sold. So in other words, I'm going to reduce cost of goods sold because I noticed that we had more inventory than maybe we expensed. What's the takeaway here? If I overstate, this is a mistake, right? If I do it by error, if I overstate here, and the inventory is going to be overstated incorrectly. If I overstate, if I count incorrectly more inventory than there really is, I'm going to do the same thing here. I'm going to put more inventory in there. So my inventory, my ending inventory is going to be over here. And by doing this, my inventory is going to be over here. At the same time, cost of goods sold is going to be under. And same thing, I'm reducing cost of goods sold when I should not have. Okay? So what am I trying to get you to see here? That every time you have an analysis of inventory errors, most of the time it relates to an issue of the count, okay? The inventory, ending inventory count, whether it's under a periodic or a perpetual inventory system. That's usually what we're talking about, okay? We go in and we say, oops, we made an inventory error by counting more or by counting less than we really have, right? So that's the first thing I want to establish. The first thing is, it doesn't matter which system it is that you're using, okay? The effect of that error from a count is the same whether it's periodic or perpetual. All right, so now let's actually look at an example through the financial statements. Now that we understand that it doesn't really matter if it's periodic or perpetual. So here's 3 fiscal years, X1 through X3. And we made one error in X1. We counted the inventory, but by mistake, we overstated. Okay, maybe we counted some boxes twice or something, and that's what had happened. Now, let me step back a second here. If I noticed that I did this error as I counted, then I would correct that and I would not have the error, right? What we're talking about here is an error that we don't know about. And it maybe comes up later on in another fiscal period that we did that mistake. Or maybe it never comes out, okay? Maybe it just continues and we never find out that the error actually occurred. So when I say that we have this error, it's because nobody has been able to figure it out, okay? Nobody was able to figure it out on time to say, oh, let's correct this. But nevertheless, it's important for us to understand how that error that nobody found is going to affect the financial statements. So going back to this original formula here, because even though this is kind of the formula you use for periodic inventory system, it still applies for the perpetual, as I illustrated above, right? All right. So here, beginning inventory, oh, by the way, when you analyze these inventory errors, you have to analyze it as if everything else is correct. So in other words, the only error that is current is this thing where you overcounted your ending inventory, and everything else has to be perfect so that you can analyze one component at a time. And that goes for any error. You gotta, whenever you analyze the error, you always have to think about everything else being the same except that error that you're trying to analyze. So here in X1, I have beginning inventory, and I have no reason to believe that anything's wrong with that because we're only analyzing the ending inventory. So beginning inventory plus purchases is fine. That gives me goods available for sale, right? From that, I subtract the ending inventory that I counted, but guess what? It's overstated. So if my ending inventory is overstated, when I subtract it to arrive at cost of goods sold, this is understated, right? So my cost of goods sold now is understated because I just told you ending inventory is over, right? So I'm just going to put some little O's and U's. Automatically, if the ending inventory is overstated because we counted more, when we put it on the balance sheet, by default, the assets are going to be overstated as well. Right? That's from that error that we did by counting. So we would say if the ending inventory is overstated, well, our balance sheet, the assets is going to be overstated as well. We just said that the cost of goods sold will be understated simply because of the formula here. Goods available for sale minus ending inventory gives you cost of goods sold. So if this is understated, when I take this number, cost of goods sold, that's understated, okay? So just so I can analyze it here. And I'm subtracting it from revenue, which is correct. So we're not going to think that anything's wrong with revenue. If I'm subtracting less expense, then naturally my gross profit is going to be overstated. If I have a gross profit that's overstated and I'm subtracting other expenses, which are correct, right? My net income naturally is going to be overstated. If I'm starting with a larger amount and I'm subtracting some fixed amount, I'm still going to end with a larger amount than I should have. Okay, the idea is that you're saying this net income is more than it should be because gross profit is more than it should be by mistake. So in year X1, that error you did, or whoever did it, I'm not blaming you, that error that occurred, that ending inventory is overstated, results in us having assets overstated, net income overstated. Now, some of you may be thinking, well, if assets are overstated, how do we, how does that balance the balance sheet? Well, keep in mind that this net income amount gets closed. Let me see if I can find some error that'll work. Keep in mind that this gets closed over here to owner's equity, right? So if net income is overstated, when we close that into owner's equity, naturally this is going to be overstated as well. So it's assets equals liabilities plus owner's equity. So these two have to sum up to the same as assets. So if assets are overstated, somewhere around here, there needs to be a balance, right? And that's how this balance occurs. All right, we're not done yet. Let's assume nobody's discovered this error, so the error continues. How does it continue? Well, if I messed up on this count, and I said ending inventory is some amount, but it's over, then my ending inventory here on the balance sheet, it's over. Well, that becomes my beginning inventory, and by default, this thing is over as well. So this is just the error carrying itself into fiscal year X2. Now, assume nothing else, and notice how I'm just tracking that error, that one error I did through its life cycle. And now it's coming over here, and it's, it starts here with a number that's higher than it should be. Nobody has discovered it. We do more purchases, and those are correct. Just assume this is correct. So my goods available for sale by default now is going to be overstated. Then in X2, I'm going to do a physical count, right? And this physical count is correct. The ending inventory physical count in X2 is correct. Remember, we're analyzing one thing at a time. So when I do this, if goods available for sale is overstated, and I subtract ending inventory for the correct amount, then cost of goods sold naturally will be overstated. So now that we understand how this error carried forward from last year goes into the beginning inventory and overstates beginning inventory, consequently overstates gas, goods available for sale, and then ends up giving us an overstated cost of goods sold, then we can see how that affects the income statement. Cost of goods sold is overstated, so if I start with that, then my gross profit will be understated, right? Because I'm assuming this is correct. I'm subtracting an overstated amount per the analysis we just did. That means that automatically by math, this gross profit is understated. When I subtract other expenses, I end up with a net income that is understated. Now, here's what happens. This is where it's going to be maybe a little tricky for you to see it. This overstatement from X1 in net income is countered with an understatement in X2. So what that ends up doing is that by us having recorded an overstatement here and now an understatement here, your net income is understated, but then your owner's equity now is correct. And I know this is kind of tricky to see. Let me put this error over here. Because naturally you're going to say, well, Adrian, you are closing this understatement into owner's equity. Yes, you're closing it into owner's equity. Remember that owner's equity is a permanent account. So if last year was overstated and now you're putting something in there that's understated, this right here, when it actually arrives in there and you do the balance, this is actually correct now. In other words, the error has reversed itself by a 2-year period. Similarly, this ending inventory, when you do this count, this is correct now, right? So on the balance sheet at the end of X2, you're going to see things that are correct simply because the error from X1 has reversed. And then when you go into X3, everything's correct. Nothing's wrong because look, you're starting out with a beginning inventory that's correct. So from there on, everything on X3 is correct. And the reason I wanted to do the 3-year comparison is just so you see that in X3, there's no lingering effects. In X2, you still have lingering effects from the income statement, but the balances that you'll see on the balance sheet are now correct because of the overcorrection, if you want to think of it, or the reversal is the more appropriate way of saying it. So this is very commonly referred to as, when we do these kind of things, let me just put a big old bracket here. Bear with me. I know this is a lot of brackets everywhere, but I think it's important to understand this. Inventory errors, left alone, okay, reverse in a 2-period period. 2 periods, let's say. That's assuming nothing has been touched, right? If that error is not discovered, you'll have an error in X1 on both the balance sheet and on the income statement. And then you'll have an error on the income statement on X2, but then that error reversal, nothing else being analyzed, no other errors being considered, right? That other error reverses out here on the balance sheet X2. So that's why commonly when you hear reversing errors, this is what they're talking about. This is how an error in inventory corrects itself over a 2-period analysis. Okay, so hopefully that helps you out. And just quickly, notice how important it is to understand that it doesn't matter whether it's a periodic or perpetual inventory system. Either way, if you make an error, you're going to be overstating or understating cost of goods sold. Okay, this is an error. Let's say that this is an error, right? I'm overstating or understating cost of goods sold, or I'm overstating or understating ending inventory. So it affects these areas right here. Let me put it in yellow. That might help. Oops, that's not what I want to do. So notice, one way or another, the effect is, if I'm using periodic, whatever error I come up with, that's going to be reflected either in both ending inventory and cost of goods sold. If here I do this and I have an error, when I do this adjustment, that error is going to be within cost of goods sold or inventory. Cost of goods sold or inventory. And that's exactly what we just analyzed right here, right? This is starting from account. This would be an error starting from account as well, possibly. Okay, that concludes the video on inventory error analysis. And again, if you want to see the one on a more general error analysis, a video that's more general about how to approach errors and the effects of the financial statements, go to that video and watch that. But this is simply the one on inventory errors.